What is an escrow account? This is one of the most common questions I get as a loan officer. An escrow account is like a piggy bank that your mortgage lender or servicer manages for you. Every month, a portion of your mortgage payment will go into this account to pay for your property taxes and homeowners insurance. Why? Because if they left it up to us to save for that kind of stuff, let's be real, a lot of us would forget about it and end up spending that money on tacos and Amazon deals. Your lender wants to protect themselves from unpaid property taxes and homeowners insurance bills. If property taxes go unpaid, a lien can be placed against the home and jeopardize the mortgage getting paid. If homeowners insurance is unpaid and something happens to the home, the lender loses collateral on the loan. The escrow account protects the lender from these circumstances, as well as helps the homeowner avoid unexpected bills that they can't cover. Okay, now that you understand what an escrow account is, let's explain what prepaid escrows are. When you close on your home purchase loan, you will see a section on your closing disclosure that collects upfront for prepaid escrows and initial escrow payments at closing. Let me show you what I mean. Okay, so this is what your closing disclosure will look like. We're going to focus on Section F and Section G, which is on page 2 of your closing disclosure. And these are the two sections that are used to set up your escrow account. So for prepays, this is where they'll collect for anything that's due at closing to make sure everything is up to date. So they'll collect for 12 months for your insurance, so your entire premium will be taken care of at closing. Any prepaid interest, so they'll calculate that based on the day you close, and they'll collect from that close date to the end of that month that you close. And then the next month's interest will be taken care of on your first mortgage payment. And then property taxes, any property tax bill that's currently due will get collected here. That may or may not be split up between you and the seller, just depends on the county and when things come due. So if there's anything currently due, it'll be collected for here. Okay, now let's take a closer look at Section G, which is the initial escrow payment at closing. So this is essentially where your lender is going to make sure that there's enough money in your escrow account to cover the property tax bills and insurance bills when they come due again. Let's take a look how that works. So let's say that you have a property tax bill due in 6 months, but remember your escrow payments are only going to start with your mortgage payments after you close. So they need to calculate how much they need to collect up front to make sure there's no shortage in there. So they'll count forward until the next due date and calculate how many monthly payments are going to be made into your escrow account before that bill is due. So if your property tax bill is $3,000 and it's due in 6 months, but you're only going to be making 3 payments into your escrow account by then, that's only going to be $1,500 available in your escrow account, since it's going to be a $500 a month payment for your property taxes. So to avoid that shortage, they're going to collect $1,500 up front here to make sure that the full $3,000 is available in there to pay the bill in full when it comes due. Now you may be wondering what the 2-month collection is right here, and that's what's called a cushion. So lenders are allowed to collect up to 2 months extra for both property taxes and insurance as a cushion. And that is to make sure in case these bills come in higher the following year. So if the insurance premium comes in next year higher than this amount, or your tax bill is higher than expected, they hopefully have enough in the account to cover those increases. They don't ever want to have to come back to you with a shortage and asking for more money. So this is a safeguard to prevent that from happening. So just as a recap, we have Section F, which is prepaids. So they collect up front for your homeowner's insurance or your first year of your homeowner's insurance and any prepaid interest. And then initial escrow payments at closing. Section G is your escrow setup, including monthly amounts needed between the time of closing and when the bills are due, plus up to 2 months as a cushion just in case there's any increases. Something else I want to add as well is that money in your escrow account is always yours. It is there so that your servicer and lender can pay your bills for you. But if there's ever a time where there's too much money in there, sometimes they'll send you an escrow refund. Or if you refinance or pay off your loan because you move or you just pay off your loan, they will always send you any extra leftover money that's in there. That money is yours. If you want to learn more about the home buying process, you can download my free Home Buying 101 workbook with the link in the description. And if you like this video, please like, subscribe, and ring that bell.